Hello good people, come back again with my new presentation video. So today I would like to calculate the flexible budget, direct materials and direct manufacturing labor variances on Tuscan Statue for my cost accounting midterm examination. First of all, let me introduce myself. I am Chantia, a student from University of Lampung. I think before we go into the calculation, I will tell you a little summary for this chapter. So, there is static budget is based on the level of output planned at the start of the budget period. Also, there is flexible budget is the budgeted revenues and budgeted costs based on the actual output in the budget period. There is the static budget variance, which is the difference between the actual result and the corresponding budgeted amount in the static budget. The flexible budget variance is the difference between an actual result and the corresponding flexible budget amount. The only difference between static budget and the flexible budget is that the static budget is prepared for the planned output, whereas the flexible budget is prepared based on the actual output. Using the flexible budget, managers can analyze uncertainty, improve performance evaluation, and conduct useful variance analysis that helps the company stay on track. So, the flexible budget usually used when the circumstances is not good, like there are a lot of unexpected and then uncertainty dynamic of the economic challenges in the world. But using the flexible budget, managers can manage this problem. Okay, next, the difference between the flexible budget amount and the corresponding static budget amount is called sales volume variance. Then the difference between the actual budget cost and the flexible budget cost is called sales price variance. So first of all, when we want to do the flexible budget with the variances, we have to know the actual units, the budgeted units, and the actual direct materials. Where the actual direct labor, what is the actual direct labor, and how the actual price, and how much the budgeted price, and the budgeted direct materials, also the budgeted direct labor. So using this given information, we can calculate the flexible variances and also the sales volume variances, as well as the sales price variance. Okay, we jump into the case of Tuscan Statue. So Tuscan Statue manufactures bust statues of famous historical figures. All statues are the same size. Each unit requires the same amount of resources. The following information is from the static budget for 2011. For the expected production and sales, there is 6,000 units, and for the direct materials, there is 7,000 pounds. For the direct manufacturing labor, there is 21,000 hours, and the total fixed cost is $1,200,000. And the standard quantities and the standard prices, also the standard unit cost for the direct materials, there is 12 pounds, and for $10 per pound. And for the direct manufacturing labor in standard quantity, there is 3.5 hours, and for the standard price, there is $50 per hour, cost 175 hours, $175. While during 2011, actual number of units produced and sold was 5,500. Actual cost of direct materials used was $668,800 based on 70,400 pounds purchased at the $9.50 per pound. Direct manufacturing labor hours actually used were 18,500 at the rate of the $51.50 per hour. As a result, actual direct manufacturing labor costs were $952,750, and the actual fixed costs were $1,180,000, and there is no beginning or ending inventories. So we have to calculate the sales volume variance and the flexible budget variance for the operating income, and the second we have to compute price and efficiency variance for direct materials and direct manufacturing labor. Let's find out the solution for the first question, sales volume variance and flexible budget variance analysis for 2011. First of all, we calculate the flexible budget for the first level of analysis. It can be known by actual result minus the static budget. So for the direct materials, in the flexible budget, it's calculated from the 120 units times the 5,500 units. It's 660,000. And for the direct manufacturing labor in the flexible budget, in steel flexible budget, it can be known by calculating the price, which is $175 per unit times the 5,500 units, result the $962,500. And we jump into calculating the direct materials in the static budget. For the direct materials in static budget can be known by calculating the price, which is $120 per unit times 6,000 units. It is $720,000. And for the direct manufacturing labor in the static budget, it's from the price, which is $175 per unit times 6,000 units, and the result is $1,050,000. The meaning of the letter of U and the F. Let me explain that when the direct materials in the flexible budget variances, which can be known by calculating the actual results minus the flexible budget, we know that 8,800 is unfavorable because in the actual results is lower than the flexible budget. And for the direct manufacturing labor, in the sales volume variances, it's favorable. Why? Because the static budget in the direct manufacturing labor is 1,050,000, but in the flexible budget there is only 962,500, which is the amount in flexible budget is lower than the static budget. So it's favorable. Also, the favorable and the unfavorable has the effect on the operating income, which the unfavorable has the effect of decreasing operating income, and for the favorable it has the effect of increasing of operational income. Total cost right here after the last slide is the comparison between the total cost in the actual budget and the flexible budget. It's, I said before, it's the first step, and we get $168,450. It's for the static budget variance. So the static budget variance is the first step to analyze for the effect of operating income. And the second level is calculate the flexible budget variance and the sales volume variance. We get $20,950 from the actual results and the flexible budget. And for the $147,500 from the flexible budget minus the static budget. For the last slide I explained before. Okay, next we go to the second question. We have to calculate the price and efficiency variances for direct materials and direct manufacturing labor. So first of all is for the direct materials, we have to calculate the actual incurred, which is from the actual input quantity times actual price, and then the actual input quantity times budgeted price, and the third is flexible budget, which is can be calculated from the budgeted input quantity allowed for actual output times budgeted price. After we get this, so from the given information, from the given information in direct materials, for the actual incurred is from the it's calculated from the 7,400 pounds times $9.5 per pound. It resulting the $668,800. And for the actual input quantity times the budgeted price is from the quantity, which is the 70,040 pounds times 10 $10 per pound, and the result is 704,000. And for the last is flexible budget. It can be known by the amount of the statutes, which are 5,500 statutes times 12 pounds per statute times 12 pounds per statue and times again with the 10 per pound statue, and it got the result of 660,000. And from the gap is the 65,200 is for the price variance, and for the efficiency variance, it's calculated from the actual input quantity times budgeted price minus flexible budget, getting the result 44,000. But why the result is unfavorable? Because the actual input quantity times budget price is higher than the flexible budget, which has been planned before. After that, getting the flexible budget variance also can be calculated from the actual and the flexible budget. We get the $8,800. And for the actual incurred in the direct manufacturing labor, can be known by calculating the 18,500 hours times the 51.50 pounds per hour. The result is $952,750. And for the actual input quantity times the budgeted price, it's from the 18,500 hours times the $50 per hours. It's 925,000. And the last is for the flexible budget in direct manufacturing labor. It's from the 5,500 statues times the 3.5 hour statues is 19,250 hours, and we times again with the 40 hours dollar, which is known the result is $962,400. So for the price variance in direct manufacturing labor, it is $27,750, and for the efficiency variance, it is $37,500. And for the flexible budget variance, we get the $9,750. So for the direct materials, it has the effect of the operating income. For the price variance, it's have the effect of increase the operating income. But the manager should watch this efficiency variance because it's unfavorable for the operating income. And for the direct manufacturing labor, it's can be known that by knowing the price variance and the efficiency variance, so manager can know why the price is why the price of the actual amount is higher than the budgeted amount, which has been planned before. There is some factors influence these points. By calculating the flexible budget, we can know the gap between the actual amount or the revenues of the actual with the budgeted revenues for that year. In this case is the Tuscan Statue for the 2011. Okay, I think that's enough for my video presentation and for the solution of this case. Really sorry because I think that I'm not clear enough to explain, but I hope that in this presentation video will help you calculating the flexible budget variances, sales volume variances, and also you can know more about the unfavorable and favorable itself affecting for the operating income and also for the direct materials and the direct manufacturing labor. Thank you and see ya!